Since joining the WTO at the end of 2001, China has become the world's largest exporter and is or is very near to being the world's largest economy. China had agreed and had undertaken on a very large number of modifications to its laws, regulations, and policies. It also agreed to do many other things over a period of years. Trading partners had concerns about the consistency of China's economic system with WTO norms, the continued large presence of state-owned and state-controlled enterprises, and various policies at the central and provincial level that did not provide national treatment for imports and/or impose trade balancing, domestic content, or export requirements on investments, and the very weak system of meaningful judicial review for intellectual property issues in China, as well as deficiencies in China's IP laws. 14 years after accession, the U.S. trade deficit with China is the largest in the world, while U.S. industries from manufacturing to agriculture to services are suffering. Here are some of the problems that they have with China. They've seen China disregard its obligations under the WTO. They've witnessed China pressure companies wanting access to China to invest and transfer technology. They have faced continued discrimination in terms of national treatment within China. They have faced massive subsidization by the Chinese government at the central, provincial, and local levels of Chinese state-owned and state-invested competitors. They have faced retaliation for pursuing legal rights in China or in the United States. They've dealt with a currency that was, for lengthy periods, artificially depressed in value, favoring exports from China and disfavoring imports into China. So while WTO accession has been good for China and has resulted in large numbers of people being lifted out of poverty in China, the bilateral trade relationship has been seriously skewed against the United States. China is far from transparent in its trading system and various laws and regulations, and China has skewed global markets for decades to come through its supportive industries, which have added capacity that bear no relationship to internal demand or global demand growth. The concerns and complaints of companies, workers, and government officials have increased in intensity in recent years as China uses its economic strength to essentially ignore obligations it finds to be inconvenient or contrary to its industrial policies. One only needs to look at the 2014 annual U.S. Trade Representatives Report to Congress on China's compliance with WTO requirements to understand we are far from having a trading partner who conforms, in fact, to many of the obligations it has undertaken, whatever gloss is put on the process. USTR Froman, in a speech at the Center for Strategic and International Studies earlier this year, flagged China's plan to require foreign firms to hand over technology and intellectual property as a de facto investment condition, and their use of their anti-monopoly law against foreign investors as significant problems, as indeed they are. Similarly, this month's paper from the Information Technology and Innovation Foundation, entitled False Promises, the Yawning Gap Between China's WTO Commitments and Practices, provides an interesting perspective on the depth of the problems faced by industrial areas where the U.S. has historically been a leader. The paper lists 11 areas where China has not lived up to its WTO commitments. First, not requiring technology transfer as a condition of market access. China has and continues to do this on a regular basis. Second, joining the government procurement agreement. That was a condition of China's accession. They originally disappointed the world by saying it would take as much as 10 years. We're out at year 14 and we're still years away. 3, SOEs making purchases based on commercial consideration, a key concern of the United States and many other trading partners, rampantly ignored by the Chinese government and by the state trading enterprises, state-owned enterprises, in fact. The SOE's shrinking share of the economy hasn't happened in many areas continues to be almost exclusive. Fourth, the commitment that foreign banks would enjoy national treatment in China continues not to be the case 14 years on. 5, telecommunications market opening to foreign producers has been a major problem. 6, foreign film distribution being liberalized, again, not being done to the extent promised. Export subsidies being eliminated, which is a requirement, not being done. Intellectual property theft and violations being significantly reduced through improved laws and enforcement. All you have to do is ask any intellectual property-based industry, movies, sound recording, software, about what the level of theft in China is, and you will find numbers that continue to be as high as 70, 80, 90%. Intellectual property theft and violations being significantly reduced, not happening. Abiding by the technical barriers to trade agreement and not manipulating technology standards, a major continued problem. And moving towards a Washington consensus model of development. That's not a WTO obligation, but obviously was the perception of the U.S. and many others during those negotiations. Many groups have filed comments over the years on the serious problems facing them in China: agriculture, services, manufacturing, all typically through umbrella organizations to minimize the possibility of retaliation. The U.S. and others have brought 33 cases against China to the WTO, typically for blatant violations of WTO obligations. At the same time, the U.S. and other countries have spent years working with Chinese agencies and officials seeking to help them comply with obligations in fact. The sad fact is that there are probably hundreds of cases that could and should be brought at the WTO against Chinese practices. Unfortunately, the system does not have the capacity for that level of legal challenges, and the timing of actions can result in irreparable harm being done to domestic industries by the time correction is required. The example of China's export duties, that which Kevin mentioned, the article that we had done on a wide range of products, is a case in point. The U.S. with other trading partners had pursued and won 2 cases against various export duties imposed by China in violations of their protocol commitments. The WTO appellate body has ruled that the list of permitted products to be assessed export duties is not expandable, and even for products on the list, the maximum duty shown in the protocol cannot be exceeded. Despite repeated determinations of violations, the Chinese government, since the day they joined the WTO, has had hundreds of products in excess of that which was negotiated by them with their trading partners, and is the example of the flagrant violations that the U.S., Europe, Japan, and all other WTO members face and have to try to deal with. One of the questions that Kevin asked us to address was, how do you measure the success of this current summit here in Washington? I have come up with 4 suggestions, in my view, none of which will be accomplished. First, are there commitments by the Chinese to eliminate the abuse of their antitrust law and eliminate the IP transfer for high-tech companies? I think the answer out of Seattle is no, that is not going to be addressed, and we will continue to see the problems. Second, is there a commitment to reduce capacity in the next 12 to 15 months for industries China itself has acknowledged face massive excess capacity, to limit their operations to those that would permit full operating rates? The answer is that is not going to happen, even though the Chinese government has committed to reduce that capacity. 3, is there meaningful agreement to restrict IP theft by government actors? The answer again will be no. And 4, is there agreement by China not to intervene in its currency markets in ways viewed as undervaluing the value of its currency? A simple request at this point in time, when many economists view the currency as probably not seriously undervalued, but even that will not be done. With that, I'll turn it over. Thank you.
I'm going to summarize here work I've been doing for the last decade or so between China's entry into WTO in 2001 and 2013, the end of 2013. The U.S.-China trade deficit increased from $84 billion to $324 billion. This growing bilateral deficit cost the United States 3.2 million U.S. jobs. We've had job losses in every state, in nearly every congressional district. Those data are available on our website. There's job losses by state and by congressional district. Of those jobs lost, 2.4 million were in manufacturing, or more than 3/4 of the total. These job losses are piling up, and they're growing every year, as we'll see by looking at some of the further data. U.S. trade deficits and manufacturing deficits are both growing rapidly. In the last 2 years, between 2013 and our estimate for 2015, I'm sorry, the next slide, over this, just the last 2 years, we've seen the trade deficit, the bilateral deficit, increase by an additional $55 billion, almost 17%. And at the same, and most, by the way, most of the goods that we import from China, virtually 95, 99% are manufactured products. And so this is directly related to the growth of the U.S. manufacturing trade deficit, which is on pace to reach an all-time peak exceeding $640 billion in 2015. I note that it's important to pay attention to manufacturing trade and to distinguish it from all trade. The overall U.S. trade deficit has been improving, and improving for really one reason only: oil. Oil consumption is down. U.S. exports of oil products are up. So oil is shrinking. That's making the overall trade deficit smaller. Meanwhile, the trade deficit with China, the trade deficit in manufactured products are going up, and that's putting downward pressure on employment in manufacturing, as you'll see in a moment. Furthermore, more than 65,000 U.S. manufacturing plants were lost between 2001 and 2012 alone. That's the latest data we have. Jobs were lost in every size class. This is Census Bureau data, with the largest percentage of plants and the largest share of jobs lost in the biggest plants. So what we lost were the biggest and most important plants, those that had the biggest impact on communities through the U.S. And I have those data available, and we can talk about it in Q&A if there is time. Next slide here, thank you. We do see this growing U.S.-China trade deficit simply between 2009 and 2015 alone, since the depths of the Great Recession. We have seen this U.S.-China trade deficit increase by more than 2/3, from 227 to over $372 billion estimate in 2015. Next slide. What is causing this? Well, I argue, sorry, we have to back up one, I think. Maybe we missed one there. Oh, dear. Oh, I see what I did. Pardon me. Yeah, well, we'll go on and look at the next slide. As I said, the trade deficit is going up. Overall, the growth of this trade deficit has led to, and the trade deficit is in the light blue line that's going up. As you see, it's heading towards a peak of $640 billion, as I said. Meanwhile, over the last 2 decades, U.S. manufacturing employment has declined sharply. We've lost about 5 million jobs overall in manufacturing, much of that due to the growth of the U.S.-China trade deficit. There has been a recovery since the depths of recession. It's very small. It's almost entirely concentrated in autos and auto parts, which is cyclical entirely. Now, I think hopefully we'll get to the next slide if I did this right. Ah, yes, the most important cause of the trade deficit is currency manipulation. Lowers the cost of U.S. imports, raises the cost of exports. It's the leading cause of U.S. trade deficits. China manipulates its currency by buying foreign assets. They've been buying on the order of $500 billion worth of foreign assets a year. Their total holdings have now reached $5.2 trillion in the first quarter of 2015. As a result of what China is doing, other countries, largely in Asia, but elsewhere as well, are also manipulating their currencies. They're buying foreign assets. They're keeping up with China, depressing the value of their currency. Together, these countries are spending about $1 trillion a year to suppress the value of their currencies, and this results in an equal distortion of trade. For every dollar they spend buying foreign currency as they pile up a trade surplus of roughly $1. If we eliminate the deficit over this, if we eliminate currency manipulation overall, the U.S. alone could create between 2.3 and 5.8 million jobs. In the next slide, you see that there's a close correlation between these official purchases, they're called, purchases of foreign assets by government and government agencies, and the current account, or the broadest measure of the trade surplus of these 22 currency manipulators over the period 2000 to 2014. Now, the next point I want to make goes back to China. Next slide. China's trade surplus is growing, although its reported global trade, i.e. current account, that's the broadest measure of its trade surplus, fell after the Great Recession. The IMF does project that it's going to grow sharply in the future. And the IMF analysis is based on China's own data, which is notoriously faulty, and on IMF projections, which are themselves notoriously conservative. Despite that, as you'll see in a moment, they're projecting broad and growing current account surpluses for China. Meanwhile, I'm also going to show you that, turning to this faulty data, that China's trade partners report much larger deficits with China than China reports on its accounts, on its total trade surplus. So I think the trade surplus that China reports is underestimated. Here you see the official reports. The data before 2014 are what's reported by China. After that, it's the IMF forecast. Clearly, they forecast a steadily increasing trend increase in the China surplus. In the next chart, what you see is the problem I mentioned with trade data. These are data which compare, they're data from the United Nations, which compare China's estimates of its trade surplus, those are the dark blue lines, with the flip side, with the trade deficit reported by China's trading partners with the world. And take, for example, the data in 2011. That's about the most recent data we have that's accurate. China reported a trade surplus, a goods trade surplus of $236 billion. Meanwhile, its trading partners reported a deficit with China of $523 billion. That's over twice as large as what China's reported. There's a lot of distortion going on in these data. I can talk to you more in Q&A about where that is happening. I think I'm running pretty short on time. How am I doing, Terry? I want to make one final point, and I'll save my recommendations for the Q&A if we have time. Next slide, please. I want to turn to this assertion, which Terry mentioned, that the Chinese currency, or the RMB, is now, as the IMF says, no longer undervalued. I maintain this claim is in error. It ignores distortions in the Chinese data. It's also inconsistent with fundamental economics. In order to achieve external equilibrium, the exchange rate has to adjust for productivity differences. Productivity is growing much, much faster in China than it is in the United States, and so China's currency must appreciate every year in order to maintain roughly balanced trade. Of course, we have nothing approaching balanced trade today. I look at the data. I'm going to look at one more slide, look at recent changes. According to Bill Klein at the Institute for International Economics, the Chinese RMB was almost 32% undervalued in 2008. Let's look at what's happened since then. The RMB has appreciated by about 15%. Okay, give them that. Chinese prices also went up faster than those in the US. They went up about 17%. Add those two numbers together, you get about 31%. On the other hand, Chinese productivity in manufacturing has gone up 6% a year versus 1.5% in the US. If you take those two factors into account, that is, changes in prices, changes in productivity, the real value of the productivity-adjusted RMB has actually declined 1.1% since 2008. So if the RMB was 31% undervalued in 2008, it's even more undervalued now. I would say at least 30% or more. So with that, I'm going to stop. I can make some policy recommendations as well, but I've exceeded my time. So I want to leave time for the rest of the panel. Thank you.
First, I'd like to thank the USBIC for including steel in the panel. Steel played a big role in the rise of China in the earlier industrialization phase of China's development. When many people looked at steel as a window to understand better China's model of economic development, and steel will remain a key part of the Chinese rebalancing process, where it will again help people to understand the many challenges that China now faces as it attempts to rebalance its economy at a time of slowing growth, record debt, endemic corruption, and dangerous pollution. I had intended to just briefly address a few generic issues with some comments on steel, but some of these I don't believe I need to say much on at all because they've already been dealt with. For example, on the issue of currency, just to mention the August devaluation, the U.S. government continues to maintain, it maintained in August, that the RMB remains significantly undervalued. This is in contrast to the position of the IMF. And now the steel industry but many other players around the world are concerned that by choosing to devalue the RMB, Chinese officials may be seeking to solve their domestic economic problems, including a collapsing stock market, a massive property bubble, and a slowing economy by exporting overcapacity and unemployment elsewhere. And the most recent trade bulletin of the U.S.-China Commission makes the point that really the burden is on China to prove, that that's not its motivation. The Chinese have claimed that it's to produce a more market-oriented exchange rate, but obviously on a daily basis they continue to manage their exchange rate. The other point is that the U.S. is the largest single market for China's exports. We're likely to be the hardest hit by the RMB devaluation, and within hours of the devaluation, Chinese steel producers announced significant price cuts to reflect the devaluation. On subsidies, I think, which Terry dealt with, the only thing point I want to make is that the Chinese steel industry was built by subsidies. It has received many tens of billions, if not hundreds of billions of dollars worth of subsidies. I was just reading a report a couple minutes ago that just in terms of energy subsidies to the Chinese steel industry, according to the World Financial Review, they exceeded $27 billion between the years 2000 and 2007. Now, the subsidies really lead directly into another issue, and that is excess capacity. Before I get to excess capacity, I want to make a comment on state-owned enterprises, which Terry dealt with briefly. With respect to the steel industry, the Chinese government has ownership interest in 18 of the 20 largest producers in China. The OECD has identified 29 large Chinese steel companies as being majority owned by the state. And Chinese SOEs control about 15% of metal production globally. On excess capacity, which is closely linked to the subsidy issue, the result of the massive industrial excess capacity in China has been to distort global markets and significantly injure U.S. producers and workers. Between 2000 and 2014, thanks to government subsidies and protection, China accounted for more than 75% of global steelmaking capacity growth. That's an incredible figure. More than 3/4 of the total steel capacity growth globally was in China in those years. Now, because the government had designated steel as a quote-unquote pillar sector, this exponential growth was allowed to occur, even though China was and remains a relatively high-cost steel-producing nation. Labor costs only are about 10% of total production costs. China does not have a comparative advantage with respect to energy and the raw material inputs that are needed for steelmaking. And so today, in the face of weakening steel demand, not weakening steel demand growth, but weakening steel demand in China and abroad, the Chinese steel industry is in a state of crisis, and its massive excess capacity, which is now estimated at between 300 and 400 million metric tons, has fueled an urgent need to export at an unprecedented rate. I intended to talk a bit about manufacturing, but Rob has already mentioned that. Obviously, manufacturing is steel's customer base, so we're very concerned about what has occurred there.
Can you just mention U.S. capacity versus Chinese capacity?
Yeah, well, just the growth in Chinese steel capacity between the years 2000 and 2014, it was about 700 million metric tons, which is approximately 8 times the size of the U.S. steel industry. So China, by the year 2013, accounted for roughly half of world steel consumption and world steel production. As important as China is as a contributor to world economic growth, that is, as it has been, it was, what, maybe 40% as a contributor to world economic growth. Think of a situation in which that country represents 50% of total production and consumption of your product. So, you know, China sneezes and the entire world steel industry catches pneumonia, which is basically what's happened. I intended to talk about environment as well briefly, but can leave it for Q&A. Needless to say, there are compliance problems there that end up lowering costs for Chinese producers. But with that as background, I want to talk about the current situation in China with a focus on steel. The world is having a hard time adjusting to the new normal of a China that's transitioning to slower growth. The end of the global commodity supercycle roughly coincided with the start of the China slowdown, and the collapse in commodity prices is having global impacts, especially on commodity-dependent countries. Now, China remains hugely important, as I mentioned, as a contributor to world economic growth, but it has not had double-digit growth for 5 years. There are doubts about the government's economic data, as Rob mentioned, and growth appears to be decelerating now at a more rapid rate than anticipated. Manufacturing is contracting at its fastest pace since the 2008-2009 crisis. And there are growing concerns about China's overcapacity, domestic demand, record debt, and structural imbalances that are combining to make it a bumpy, uneven process to rebalance the Chinese economy. Overcapacity in industrial sectors and a debt-to-GDP ratio that now exceeds 280% represent the greatest risk to Chinese growth prospects. And a so-called hard landing of China's economy is now the key risk facing the world economy. The collapse of the Chinese steel market is important mainly because it reflects a decline in investor confidence in the fundamentals and growth prospects of the world's second-largest economy. What we can see from the performance of stock markets around the world is that China is now exporting volatility. Turning specifically to the Chinese steel sector, the symbol of the rise of China, which by 2013, as I mentioned, accounted for roughly half of world steel production and consumption, steel in China is already experiencing a hard landing. With much of the Chinese steel industry owned by local and provincial governments that often do not listen to the dictates from Beijing, the Chinese government's latest steel adjustment plan is fighting insurmountable obstacles in the face of steep declines in domestic steel demand, enormous steel overcapacity, unprecedented low steel prices in China, and record financial losses for Chinese steel producers. Domestic steel demand in China this year is expected to decline by 3.5%. And so forecasts of global steel demand in 2015 are also being adjusted downward. While China's overall exports grew only 1% in the first half, China has been increasing significantly its global exports of intermediate goods, including steel. With so much steel overcapacity and such low steel prices in China, there has been an increase in record-setting Chinese steel exports to the rest of the world. This has disrupted and destabilized global steel markets and contributed to a severe steel price deflation globally, which is making it difficult for even the most efficient steel producers to earn a profit. Chinese steel exports to the world this year are expected to exceed 100 million metric tons. It's bigger than the entire U.S. steel industry. And so, not surprisingly, steel industries in every part of the globe are taking self-defense actions. Recently, steel producers in the U.S. and North America were joined by producers in South America, Europe, and Asia to urge in a joint public statement that their countries continue to treat China after December 2016 under so-called non-market economy anti-dumping methodology. And today, steel producers everywhere are complaining about injury from increasing imports from China, and so countries everywhere, including the U.S., are taking steps to enhance trade defense measures, and some countries, such as India, are using new creative forms of protection, such as licensing and standards, some of which may be WTO inconsistent. Of course, the trade situation of U.S. manufacturers, including steel producers, has deteriorated because of the strong dollar as well. But here, too, as I mentioned, the recent devaluation of the RMB by the People's Bank of China will only exacerbate this problem. A few closing thoughts. There is a declining belief in the U.S. and many countries that more free trade and globalization will lead to higher income growth for low-income and middle-class workers. This was a key part of the U.S. fast-track debate. As globalization enters a new phase, and because the benefits of free trade agreements have been oversold to citizens in many countries, new populist movements are on the rise, and economists and politicians in the U.S. and elsewhere are beginning to talk about the need for new trade paradigms and new types of trade agreements. Never before in human history has a non-market economy had such a profound effect on world trade. So the reality and the effects of the Chinese model of state capitalism have only fed the public's increasing skepticism about the benefits of so-called free trade. As for what we'd like to see come out of this U.S.-China summit, more Chinese commitments to do this or that would be nice, but they're often not worth the paper that they're printed on. Therefore, what we'd like to see first and foremost is for the United States to enhance its own trade defense mechanisms and for the U.S. to take a much more aggressive and creative trade policy stance with respect to Chinese unfair trade, investment, and currency practices. It's a given. China will continue to act as and when it chooses in its own national interest, especially in this difficult period of transition for its economy. And we believe the U.S. must do the same. Our recently enacted domestic legislation to strengthen U.S. laws against unfair trade for the first time in 20 years was one step in the right direction. But much more needs to be done, and we can start by acknowledging that China is not a, quote, market economy with Chinese characteristics. As the example of steel makes clear, China remains very much a non-market economy.
I want to thank Kevin and USBIC. It's a pleasure to be here, and I think it's great to sort of be batting cleanup and try and wrap some of the things that have been said by earlier speakers together. I think the AFL-CIO views what's happening economically with China in a very similar way to some of the other speakers. Many of our affiliates have led trade cases against China, whether it's steel, whether it's tires, all kinds of issues. But I think we would criticize how the U.S. is approaching the situation as much as we would criticize how China is approaching the situation. And I think that was something that was reflected on the first panel as well. The U.S., likes to talk about there are troubling issues with our relations with China, but then it goes about trying to solve them in a completely nonsensical and incoherent way. And I think the TPP is really a perfect example of that. So the current administration is pitching the Trans-Pacific Partnership, a trade agreement amongst 12 very diverse nations, as some sort of answer to the problems that the U.S. has with trade with China. But if you look a little bit deeper into what is the TPP all about, why this grouping of countries, is it going to do what we're being told it's going to do, the argument for it really starts to fall apart. And you start wondering, in whose interest is the TPP really being negotiated? And to us, that's one of the major problems, is that the U.S. seems to have a particular trade template. Folks have mentioned earlier the Washington Consensus, neoliberalism, trade policies that really go for dismantling the public sector, lowering all tariffs, not looking at them strategically in any way, trying to minimize what are the ways that you help workers and industries transition from something that's fading away to something that's growing, and keeps putting this one-size-fits-all trade policy onto all of the different trade relationships. It hasn't worked great in the past, and it's not, in our view, going to work better with the TPP. So we think there are three critical questions to ask when looking at the TPP. One, will there be some sort of meaningful boundaries between the economic grouping of the TPP and China such that the TPP is going to induce China to change its behavior in ways that the administration is saying that it will? Well, it won't. And that's for two reasons. One, if you look at the actual rules of the TPP, what we're finding out, and there were talks that were just completed in San Francisco, particularly on the auto rules of origin. This is really emblematic of the problem. If the rules of origin are so weak or so low and require so little content from the 12 countries that are in the TPP grouping, then Chinese inputs that are made far out of compliance with whatever the rest of the rules of the TPP are get into those products and get into all of the TPP markets at preferential tariff rates. And, Chinese firms and the Chinese government hasn't had to do anything to adjust how it's competing to take advantage of the TPP grouping. So that makes no sense. Secondly, China's work already has very strong economic relationships with all of the countries in the TPP. China is in the top 3 importing countries and exporting countries for every single country within the TPP. So those relationships are there, and there's nothing about the TPP that would make those relationships go away. There's nothing exclusive about the TPP, and that's doubly so once you remember China's negotiating its own version in the form of the RCEP, and with the new Silk Road, the Maritime Silk Road, all of the investments that China is doing with its neighbors and including with TPP countries, this argument that somehow the TPP is going to draw China toward the U.S. way of doing things, it just falls apart. And you even have to assume that the U.S. way of doing things in all these cases is somehow better for Americans, and we have doubts about that. So the second question, is the TPP really focused on the correct issues in relation to U.S. objectives with China? So the U.S. says that it wants to move China away from state capitalism, export tariffs, subsidies to state-owned enterprises that prevent them from operating with commercial considerations. It wants to move China toward higher labor standards, better environmental standards, better human rights, rule of law, fair application of laws, not arbitrary use of the anti-monopoly law, et cetera, et cetera. So are the rules in the TPP designed to do this? No, they're not. There are going to be rules about state-owned enterprises, but from what we know, they're going to be fairly weak. They're not going to be focused at all below the federal level of government. So even if China were to come in and join the TPP, most of China's state-owned enterprises are below the federal level of government, so there would be no rules on them at all. And it's not clear really how U.S. firms that felt they had been injured by unfair competition from a state-owned enterprise in a TPP country, how would they use these rules and would they be effective? Or would they be very similar to the rules that we have now with anti-dumping and countervailing duty laws where workers have to be laid off by the hundreds and thousands and firms have to be on the brink of destruction before they can really see relief? So that's a problem. Also looking at these other, the promises about labor rights, environmental rights, human rights, as we should know from past trade agreements, these standards don't simply rise through osmosis. We keep being promised, CAFTA was a great example, if we just trade more with Central America, all of these governments, they're going to get rule of law. Labor standards are going to rise. You're going to see how fantastic it is. And the exact opposite has happened. We have countries like Honduras and Guatemala in which rule of law is far worse now than before CAFTA. Now, a lot of reasons for that. We've had the global recession. You can't blame it solely on CAFTA. But it also undermines the argument that simply trading with a democratic nation is going to spread democracy. It's simply not happening. We need to have rules in place to force that. And the TPP isn't really focused on those rules. Finally, are the standards that are embodied in the TPP actually high standards in relation to China, such that it matters for U.S. workers that we can see the rules that we're actually going to move in the correct direction? And again, we look at it and say, no, they're not. So first of all, there's no rule in the TPP about currency manipulation. You heard a lot of that about that from Rob Scott. if we're going to try and level the playing field and prevent competitive devaluations, there have to be currency rules in the TPP. There aren't. Secondly, if we look at the labor rules, we know there are problems with labor law in China. There's no free and independent trade unions. There is no right to strike. There are a lot of wildcat strikes because the one government-controlled federation doesn't really do the job of independently advocating for workers, so workers strike on their own. But what it looks like is going to happen is a repeat of prior labor standards in prior trade agreements, and we know those don't work particularly well. Even when you have an administration that says, we are doing the best that we can to enforce these, if we look at it, even that doesn't work. So we need a real change in the standard, and if there isn't, what it looks like is what's going to happen is the TPP is going to take what are rising wages in China and promote a lot of investment in Vietnam that will halt those rising wages in China. So rather than having some of the reshoring back to the United States of manufacturing that's been happening in a trickle, in part because of the intellectual property problems that have been discussed, the arbitrary rule of law, all of these things rising wages in China, now those jobs are going to move to Vietnam instead, where wages are about a third of what they are in China. And we're actually undermining potentially what we're trying to do with rule of law in China by giving firms a right to a separate, totally separate justice system called investor-state dispute settlement, which can be used to actually arrest rule of law, because firms have a history of using this particular recourse when they don't like the regulations that are being put on them. The ISDS is a way of sort of firms trying to free themselves of the straitjacket of democracy. Now, certainly there are questions, again, about arbitrary application of the rule of law, but it's the way to get at the answer to that problem to exempt international firms and say you don't have to use the domestic system. Everybody else here does. All the citizens, all the workers, anyone trying to get justice in their own society has to use that system. But you, global firms, get your own private system. We just think that's not an effective way. So that is my time, and I'll stop there. Thanks very much.
Deng Xiaoping said you want to rebuild China's comprehensive national power. And the way you do that is you build your economic and technology base, and then you build your military base upon that. Now, we've heard Mike and the military people tell us that China is building its military strength very rapidly. And then this panel has told us part of the reason they're doing that, they're able to do that, is because our trade policies are totally misguided in how we're dealing with China. And you mentioned, okay, why don't we call a TKO? Well, I think part of the problem, and I want to ask the panel this, is because some American corporations, the multilateral corporations, are making money by outsourcing jobs to China, enriching their shareholders, and the CEOs who have tied their own compensation to shareholder value. So part of our policy, in my view, is we have to change the behavior of our own corporations and the way we do corporate governance in this country. For example, why not give a very low tax rate to companies that produce jobs and produce product here in the United States, and a very high tax rate to companies like Apple that produce all the money and jobs in China, and then bring us back here? Can't we have to do both the trade policy, but as Mike mentioned, we have to do more than that. We have to look at our domestic and how we can influence the behavior of our own corporations. Do people agree with that analysis or not?
Well, thank you, Pat. We appreciate the question. Let me just say one or two words about it. You know, the history of currency policy, trade policy over the last, well, let's say since the late 40s, since the GATT was first set up. And, you know, Terry can tell you all the ins and outs of that. But we've certainly had currency manipulation, which the United States has not addressed forcefully since the Plaza Accord, right, in the Reagan administration. And the prior effort was by Richard Nixon on August 15, 1971, when he closed I remember listening to the speech a Sunday night when he closed the gold window and imposed a 10% surcharge on foreign goods, which led to the Smithsonian Accord. So earlier in this century, in the past century, presidents took currency much more seriously than they have since the Europeans took the matter to the WTO and got rid of our Foreign Sales Corporation law. The VAT taxation, 150 of our trading partners have VATs, which give rebates upon export of goods and serve as a barrier to goods coming in. That's something that we have tried to settle. Well, we got into the dispute originally when the GATT was founded, and successive American administrations tried to do something about it. And again, Terry's an expert on this. But we've given up in later years. We've given up on so many areas that are causing us to fall behind, causing the transfer of wealth, based on the transfer of manufacturing factories and jobs to these other countries. Tax policy is fine. I think it has to be a multi-front effort, and I certainly we can start with tax policy too. But go ahead, Barry. Yeah, and any of you who want to speak.
I just want to get back to the national competitiveness strategy because
Move the microphone over, Barry, so you can.
the national competitiveness strategy because the 2008-2009 global financial crisis and I'm sorry, is there a button?
Yeah, it should be.
Doesn't work.
Goes on and off.
Can you
Or
hear me?
just shout.
Okay, well, the 2008-2009 global financial crisis and so-called Great Recession is really still reverberating through the world economy, and we're in a period now of relatively low growth. There are a few exceptions. India is growing again at a pretty high rate. Some of the ASEAN countries, some of the Middle East, North African countries, but generally speaking, it's much lower growth, and that includes both the United States and China, among many other countries. And of course, as far as the so-called BRICS were concerned, I mean, the only country now of the BRICS whose economy is growing faster is India. Brazil is in a serious recession. Russia is, I don't know whether you want to call it a recession or a depression. And of course, China nobody believes the 7% growth. Some people are saying 4 to 5% or 5 to 6%, but it's a long way from what it was, and it's decelerating quite rapidly. So along with this slower growth, lower investment, global environment, you've got real concerns here, there, and everywhere, including in China and of course here, about income inequality and the effect that income inequality has on demand and growth. And so, this question about, how do we do things to improve the lives of our own citizens, I think requires a comprehensive competitiveness strategy that encompasses infrastructure, not just of the physical kind, but of the education kind, encompasses trade policy, tax policy, and a whole lot of other policies. And the goal, among other things, needs to be to raise wages. And China's facing its own income inequality problem, but this is now really something that's global, and it's I think also affecting the way people here, there, and everywhere are thinking about these trade agreements, because because most people are not viewing these trade agreements as being beneficial to lower income and middle class workers.
Okay. Terry, did you want to say something? And then Rob and Celeste.
Pat, with the exception of somebody like Rob, one of the fundamental problems that we've had policy-wise in the last half-century is that the powers that be in both parties have viewed trade policy as an absolute. And anybody who ever studied science would say that you typically have certain assumptions and certain rules, and you then see how those assumptions and rules explain the data points that you get. It is only in trade where we have come up with this absolute that trade liberalization in all circumstances is an absolute positive. And then when the data points don't give us the results we want, we look at the opponents and say, well, obviously there's cheating, there's unfair trade going on. A country like China, we have such different systems that if we're going to have balanced trade in the next quarter century, we probably have to re-examine the basic philosophy under which we do trade with China. And instead of simply assuming that at some point in time China will get it right and get with the game and change what it's doing, which is distorting the outcomes, we have to define what the outcomes that are acceptable and figure out how we work that out with China, because we then are on, in fact, a level playing field without being trapped in this kind of intellectual construct which has handicapped us for decades and led us to the kind of massive trade deficits that we've been experiencing for the last 4 or 5 decades.
Go ahead, Rob, please.
Pat, thanks for your question. I think, to my way of looking at it, we've got to develop strategies to help rebuild manufacturing, rebuild America. And some of these strategies can be good for workers in China, too. I think it's important to cite that the people who've benefited from this process of globalization we've gone through have not been workers in the U.S. or China. It's really been multinational companies. It's been the owners of these firms. It's been the state officials who've profited from the state ownership of these companies directly and indirectly. I think in terms of hierarchy of what we do, with all due respect, I think taxes are a tiny part of the economic pie, and I'm not particularly interested in giving carrots to corporations that's, for trying to rectify their bad behavior. I think we level the playing field. The first most important thing to do, the biggest thing we can do, is get the currencies right. It means 30% appreciation of the RMB and the other countries that are manipulating. Second thing we have to do is we have to rebuild demand for manufactured products here in our own country. Certainly ending currency manipulation will do that. There are other things we can do, like rebuilding infrastructure, like investing in clean energy and other clean technologies. This will create demand for domestic manufactured products. So I'm working on some new strategies for doing this. In terms of my policy recommendations, I recommended things in the short term, like passing the currency bills that are currently being considered in the House and the Senate. H.R. 820, the Currency Reform for Fair Trade Act, in the Senate. S433, the Currency Undervaluation Investigation Act. That's a first step. Small steps, but they're important steps. Treasury has authority to act now to countervail some of this currency intervention. So those are just some things that we can do, but we have to step back first and have a strategy, have a plan before we can act.
Did you want to say something, Celeste?
Sure. There's not much to add. I would agree with the other statements, but it's getting back to the question of doing things that are good for Chinese workers. We do want wages to rise in China. We do want demand to increase in China. It's interesting that the U.S. continues to pitch these trade agreements as we're going to sell all these exports abroad, but then it doesn't explain what exports exactly we're going to sell in countries where the average income is, close to $2 a day. That's not a great market for U.S. exports. So we do want to create a virtuous cycle of rising growth and rising demand, and what the U.S. has been doing hasn't been working. So it is about changing the incentives for the corporations, but I think it's also taking U.S. policymakers and having them really think about and act on, just because our biggest companies say it's going to be good for them doesn't necessarily mean it's good for building a sustainable U.S. economy where workers have confidence that things are going to get better in the future. So the interests are not necessarily aligned between what's good for the companies that want to outsource and want to push down wages and what's really good for workers everywhere.
It seems to me that, if there is still going to be a WTO that is relevant, it's going to have to, at some point, deal effectively with state capitalist systems. What's your view on that?
Well, it's certainly the case that the WTO today can't deal with the modern issues that have arisen in the last 30 years because you have a fundamental disequilibrium amongst the major players in terms of expectations and feelings of what each has to contribute. That means if you're going to deal with this type of an issue, it has to be dealt with either bilaterally or in a small group setting. Now, as Celeste went through, we've kind of missed the window of opportunity in TPP, it appears, where one would have hoped that we would have had a much more robust set of rules to deal with it. But there are other opportunities to deal with it, and it's an issue that far exceeds now just China in terms of its relevance. Again, if the model that we pursue is the model that has been created over the last 70 years, the number of things you have to change to get back into balance, whether it be with state capitalism or any other form, are so many and so likely to be long-term that we will be far bankrupt many times over before it happens. I think the real answer has got to be a reevaluation of what you're looking for out of a trading system, which is much more a results-oriented approach that says we are looking for something that leaves countries in a state of equilibrium, not with people being permanent debtors or permanent surplus countries, right? And that you could do relatively easily, but it requires an enormous mind change in both parties amongst all the intelligentsia who are absolutely convinced that we have an absolute truth.